to get started in real estate and you're looking to get your first property that you're either going to house hack or you're going to purchase, live in it for a while, and then later rent it out. If you are trying to do that, do you know that you can do it without having to put 20% down? Let's talk about it. Unless you're a veteran and you have access to VA loans, typically what you'll be looking at and to be able to put down less than 20% is going to be an FHA loan or a conventional loan. Now, which one you choose really does come down to a number of things. Number one, it comes down to your credit score, how much you actually have saved that you could put down towards the mortgage as a down payment. It also depends on your debt to level income and your overall goals in general. But conventional loans and FH loans do have their distinctions. So let's talk about it. Typically, you see that the down payment that most people will say is that you need to save is 20%. Now, the thing about it is that with conventional loans, you can put as low as 3% down. And with FHA loans, typically 3.5% down. So how do you really know which one works? If you look at conventional loans, those typically are going to be more for those individuals who have a pretty decent credit score, maybe 680 or higher. They don't have a lot of debt to income. Maybe they don't have a whole bunch of student loan debt or just not a lot of debt in general relative to the amount of income that they're bringing home. And they have a good level of income coming in. And so those tend to lean more towards those people who are they're a little bit more financially stable and they're able to qualify for the conventional loan. Now, you can certainly put the 3% down with a conventional loan or put less than the 20% down. However, when you put less than 20% down, you do have to pay what's called private mortgage insurance, which essentially protects the lender for lending to someone who's put less down. And it just gets more skin in the game. So you have to pay that every month, and that's going to be a part of your bill. Now, the upside to that is that once you've paid at least 20% of your mortgage off, the PMI can fall off, and then you would not have to pay that anymore, which is very different than if you went with the FHA loan. The FHA loan is more so for someone that is, yes, they're putting less than the 20% down, but perhaps their credit score is 580 or more, but not necessarily at that 680. Or maybe their income isn't that strong, or they have high debt. So the debt to income is much higher than they will be able to qualify with for a traditional conventional mortgage. And so those come into play. Now, imagine maybe you have a whole bunch of student loan debt and you're trying to pay that off, but it's really making your debt to income much higher. That might lend towards a FHA loan as well. Those are insured by FHA, which is the Federal Housing Administration. They don't lend the money, but they insure it. And you do have to pay insurance on this one as well to cover them for lending to you, maybe with a lower credit score, higher debt to income. They want to get more skin in the game for that. So you will have what's called mortgage insurance premium. With that, you will have to pay that actually for the life of the loan. And the only way that you get out of that is by refinancing it into a conventional mortgage. It doesn't automatically fall off. In fact, even if you did put 20% down, which if you put 20% down on a conventional mortgage, you would not have the mortgage insurance. But even with FHA, even if you put 20% down, you're still going to have that insurance. So it would not make sense really to go with FHA in most cases if you already going to put 20% down because the insurance that you're going to pay on that is going to be much higher. But like I said, you could refinance later on. If your credit score is at the 580 or you have a higher debt to income, and you still want to go ahead and get into the property, maybe the FHA loan might make the most sense. Now, the lower your credit score is, even with conventional or FHA, you'll see that your rate is typically going to be higher that you'll get on your mortgage. So that's something to think about as well. So maybe if you're teetering on the lower end of the credit score for either the conventional loan of 680 or the FHA loan, I think about 580, you might want to do some things that can help boost that credit score even more. I think I saw statistics out there that said that many people who go with the FHA loan still are hovering around the 670, 680. So a lot of times it's more about just trying to get access to the lower down payment. Maybe they have a higher debt to income or their income in general just isn't strong. So just to recap on that 20% down. So if you put 20% down, obviously you're not going to have to pay any insurance on the conventional loan, like I mentioned. And if you put 20% down on the FHA loan, you're still going to have that mortgage insurance premium. Typically, though, if you put less than 10% down, it's definitely for the life of the loan. If you put 10% or more down, not 20, doesn't make it go away, but if you put 10% or more down, then that might last for a shorter period of time. You definitely want to check with the lender that you go with. But again, there isn't necessarily a direct benefit to putting 20% down on the FHA in terms of being able to get rid of that mortgage insurance premium. Now, if it makes sense for other reasons that, like I spoke about before, then that's something to consider. So now either one of these loans would work well for maybe a single family home that you are later going to rent out, or maybe you're going to rent out a room, or maybe, you're just going to later get enough property and rent it out solely and you're not going to house hack at all. But what if you actually want a house hack? You can actually use the conventional loan or the FHA loan to house hack. So whether that's renting out a room or actually what a lot of people don't realize is that you can get up to a 4-unit property typically using a conventional or FHA loan. So the rules tend to be a little bit easier when you go with the conventional loan in terms of just being able to get approved for up to the 4 units and how they go about that process. But you could use either one technically. So imagine being able to put 3% down or 3.5% down and still get a multi-unit property. That's huge. They do have some rules that might come into play in terms of looking at the income generated from the other units in order to qualify for the mortgage. But nevertheless, still being able to put that small amount down compared to 20% is a huge deal. And you can certainly get started in rental real estate with 20% down. But if you do not have it, or your debt to income or your credit score isn't exactly where it needs to be or where you want it to be, you can't just shop around and look and see what might make the most sense. You might be able to get started sooner than you think.